Okay. Right.
Great. Hi, Ben. Thank you for coming back to talk with our clients about the deal that you guys currently have. So you can go ahead and then we can post questions on the chat or ask as we go along. Thank you.
Sure. Well, look, thanks for having me here, Ebere. This is a very great investment opportunity. I'm going to start with a couple of disclaimers. If you hear me coughing and sniffing, it's because my entire family has the flu right now, including my 2-year-old and my 8-month-old. So don't worry, you won't catch it from me, but that's what happens if I cough or if I sniff. And the other quick disclaimer I'll start with is that this is normally an hour webinar. So I've cut this down to about 30 minutes. Because of that, I'm going to have to read from my notes a bit more. So apologies in advance if it doesn't come through as smoothly as it might. I will actually share the full webinar link to you guys after this. If you're interested, you can watch that and it just goes a little bit deeper. But with that, I'm excited to get into it here. So the deal we've got on the table is it's called the Lennox. It's formerly called the Gallery. We're rebranding it right away. And, as a high level overview, we're projecting this deal to net our investors an annualized return of around 18% over a 5-year period. And this is in line with our track record, where we've returned an average return of 25% to our investors over our last 5 deals that have gone full cycle. So I'm going to skip through some of these slides. Here's an important one. If you do want to actually invest in this deal at any point, you can head over to rsnpropertygroup.com/commit, and that'll kick off the investment registration process for you. Now, I'm going to start with a multifamily syndication overview because I'm sure some of you know what a multifamily syndication is and others of you are learning for the first time. It's pretty simple. At the end of the day, it's not that different from a single family home flipper. So the single family home flipper buys a house that's a little run down, gives it a new lick of paint, new roof, new kitchen, new floors, all that good stuff, sells it for a profit. That's essentially what we're doing, except on a much bigger scale. We're not doing it on a single unit. We're doing it on an 88 unit building in this particular case. So bear with me. The differences beyond that I'll touch on here. In the example of the single family house flipper, the investor has to do all the hard work of finding the property, managing the contractors or doing the work themselves. In our case, we as RSN Property Group are the managers. We do all the hard work on your behalf. It's 100% passive for you. The second difference is that for a single family home, the investor funds the deal themselves. In our case, we form a syndication with multiple investors where everyone owns a small piece of the deal. At the end of the deal, we sell and we make a profit. Investors get 70 to 80% of the profit. And for us doing the hard work, we get 20 to 30% of the profit. And that's primarily how we make our money. We all share in the success of the deal. Excuse me. And the third key difference is when you flip a single family home, you can't rent it out while you're renovating it. You're not getting rental income. For a big apartment building, we only renovate each unit when a tenant moves out, which means we're still collecting rents from 95% of the units. So there's regular cash flow that gets distributed quarterly to our investors throughout the life of the deal. So a quick recap. We do all the hard work. It's 100% passive for you. And for all of our hard work, we get 20 to 30% of the profits at sale time. Investors get 70 to 80%. And every quarter, you get a check from the rental income. Now, I'm going to talk about our investment approach really quickly. And like I said, there's going to be a few slides I have to jump over as we go through this because I've shortened it. But at the end of the day, part of our thesis is that for better or worse, America is becoming a nation of renters. We've got the lowest home ownership rates in 50 years. I think I saw this morning that the affordability is the worst it's ever been in history, or the worst it's ever been in 3 decades. So, people need rental housing, and we're providing a much needed service and product to the community that needs it in safe, affordable housing. So I'm going to briefly, sorry, excuse me, I feel terrible for coughing so much. I'm going to talk briefly about our team here. We have Reed Goosens, who's our founder and CEO and my business partner, and then myself. And then we've got Mary, who's our chief financial officer. Josh is based in Phoenix, and he does everything to do with Phoenix asset management. He helps on the acquisition side. He's our boots on the ground in that market. Juan Espinoza is our investor relations. He'll basically be interfacing with all of our investors to help them make their investment, answer any questions, deal with any things that come up throughout the life of the hold. And Austin DeGue handles acquisitions on a national level. And then we have our two analysts that do a bunch of underwriting and all sorts of other stuff for us. And we've also got CalCap, who is going to be the property manager for this deal. So they manage over 5,000 units in a number of markets, and they actually already manage 3 properties for us in Phoenix. So we know exactly what we're getting into with them. They're a great company. They do a great job of property management. So we're really happy to partner with them again here. Now, we'll jump into the property overview a little bit. And
before we do that, could you please go back to the team members? I had a quick question on that.
sure. Oh, sorry.
Okay. So you have somebody that's a chief financial officer, then you have asset management, pretty much manages the asset itself, not the portfolio, but the property. So are they the ones that are liaisoning with the management company?
Yeah, that's exactly right. So the property management company gets 3% of the revenues. It's not like 8% or 10% for a single family house, just because it's a bigger asset, more revenue coming in. But we don't just, sit there and get reports from them. We're constantly writing them and saying, hey, why is occupancy low? Delinquency is trending up. We want delinquency to trend down. Tell us about the situation, with this tenant that you said's a problem. So we're very hands-on to make sure that the asset is running as great as it possibly can. And Josh plays a big part in that. And, we have, weekly calls where we're discussing all of the assets and, it's kind of a team effort to figure out, what we need to do to keep these things on the rails and be as successful as possible for our investors.
Okay, and then Austin is the one that handles acquisition. So pretty much he's the one that goes out and finds these deals and then brings it to you guys. And I'm assuming Abby and Charge are the ones that analyze the deals.
Yeah, that's exactly right. So Austin, he's got a giant spreadsheet. He's probably doing like, I don't know what it is, 50 deals or 100 deals every month in our key markets, the Carolinas and all over, just constantly looking for those needle in a haystack deals. And, we're throwing out lowball offers effectively on all of these properties. So, we're not trying to come in at market rates where we're looking for the stars to align where a seller needs to sell quickly and we can get it for, 10%, 20% less than market or, get it with really good terms. And that's fundamentally what he's doing, all day, just finding properties, underwriting properties and putting out offers on properties.
All right, is everybody on this team working full-time? I know you and I don't know about Reed, but I know that this is what you focus on primarily, but is everybody else pretty much working full-time?
Yeah, everyone's full-time except for Mary. We just don't need her to work full-time yet. And she's one of the most expensive people on this screen. So her work fluctuates, around tax time. She has to do, a lot more work. When we close a deal, she has to do a lot more work. But, when we're in the middle of between a couple of deals, there's really nothing for her to do, very little for her to do. So yeah, everyone else is full-time.
All right, and final question is, what's your primary role?
Yeah, so, Reed and I are ultimately responsible for everything about the business, but we kind of have a split of duties where he's responsible for the physical side of the house, which means, all of the asset management, the acquisitions, everything to do with the assets themselves. I'm more focused on the equity side of the business and the marketing side of the business. So raising capital, dealing with all of the tax matters, dealing with all of like legal compliance, all of that kind of stuff. And that's roughly how we split things.
Okay. And then I have a question here from Lorelei. If you already have a syndicated deal in play, how can you add new investors to that particular deal? First question is, do you even add new partners to an already existing deal?
Yeah, so on our deals, we'll typically have anywhere from 100 to 250 investors that come in depending on the purchase price of the asset. And this particular one, we're about 80% subscribed now. So there's still some allocations available. So the people on this call can absolutely invest if they choose to.
Okay, all right, thank you.
No problem. So with that, I'll jump over to the property overview a bit. And like I said, I'm going to jump over a bunch of these slides in the interest of time here. I'll send the webinar out. I'll also send this full deck out so you can view that at your leisure as well. And I will mention that we're purchasing this asset from a group out of Quebec, Canada. They've owned it since 2018 and they've operated it remotely. And given that they're remote, we believe, and so does CalCap, that there's just plenty of low-hanging fruit that we can grab by bringing on professional third-party management and having an actual physical presence on site. And we touch on this somewhere else in the deck, but the biggest indicator is the rents are 25% below market for absolutely no reason. They're just, I don't know if lazy is the right word, or, they don't have their finger on the pulse, but, they're just not managing it as well as it could be managed. So we're excited to come in there and turn these units and pump those rents up really quickly. That's just one example of many where this current operator is not really doing the greatest job. And talking about the asset itself, it's a boutique rental community with 88 homes in a 2-story garden style layout. It's all 2 and 3 bedroom units, which is quite unique for this area. There's usually a lot of studios and 1 bedrooms. So we're really positioning this much more to families rather than, singles and whatnot. It has a pool, a leasing center, some limited community amenities, and we're going to really improve that as part of our value add plan. So we're going to be, installing a dog park, a kids playground. We're going to be making the pool all nice and fresh, probably put up new sails, new deck chairs, refresh the barbecue area, all that stuff that makes it, a lot more presentable and the kind of place that people really want to live in. We plan to renovate over 90% of the units to what we call our platinum level. We have 3 levels, silver, gold, and platinum, and we're going top tier for this one. And, that's going to consist of granite countertops, new cabinets. We're going to change the sinks, change the faucets, fix the flooring if necessary, especially if there's old carpet and things like that. So these units are going to look brand new once we're done with them.
All right, where is it located? And then, okay, I had a question about the amenity, but I think you said it was the pool.
Yeah, I mentioned the pool. Yep.
Okay. And what state is this?
Oh, sorry, if I didn't mention that, shame on me, but this is in Phoenix, Arizona, in Tempe. And the next section after this is the market overview, where we're going to talk about, the Tempe market and the Phoenix market.
Do you schedule the investors? Are you able to schedule like on-site visits for investors, or that typically doesn't happen?
Yeah, we can absolutely do that. So we need to arrange it with like 2 or 3 days notice, so that the the seller is aware, the on-site property management is aware, and whatnot. And if push comes to shove, we can let people visit the property, but they just have to be very careful not to kind of talk to anyone, or just present themselves as more of someone who might want to live there rather than someone who wants to invest there, kind of thing. And we couldn't send 20 people to do that. But to answer your question in short, yeah, we absolutely arrange that all the time.
Ben, I have a follow-up question in regards to that. In terms of travel expenses, if an investor decide to go visit the property physically, how would that work?
If the question is, would we cover travel expenses? No, we wouldn't cover travel expenses. Maybe if someone was coming in for like a super high ticket of like $1 million or something like that, we'd entertain it. But no, due diligence costs are borne by the investor.
Okay.
And Laurie asked here about 1031 eligible. The answer would be yes, as long as you meet all of the requirements to do the 1031. Also keep in mind that you are able to do a reverse 1031. Reverse 1031 means that you can actually purchase, you can actually participate in the purchase of this property ahead of selling your existing property. The only requirement is that you need to identify the QI, the qualified intermediary, immediately, and that qualified intermediary would have to put the title of this ownership in escrow. Because this is a partnership deal, the 1031 that you're going to be doing would be the 1031 of the partnership interest that owns the property. And then, so it's to make sure that whatever it is that you're going to be selling is also going to be the partnership interest of another property that you own. So just to keep all that in mind as you're thinking about the 1031, if you wanted to do reverse the qualified intermediary must take ownership and title to this property prior to you selling the other one. And also the title must be the same on the property that you're going to be relinquishing. So you can't say, oh, I have a property in my name, and then I want to 1031 into an LLC interest. That's not going to work. It needs to be LLC to LLC or property to property.
Yeah, thanks, Ebere. And I'll add a couple of things to that. You know, we I won't get into the complexities of how we do 1031 exchanges, but I will say that we do need to know if someone wants to do a 1031 exchange quite early in the deal. If someone wanted to do a 1031 exchange into this deal, we could see what we could do, but you would pretty much have to like start talking to me today about that. The other caveat is that we typically say that the minimum for a 1031 exchange is 750K because there's a lot of legal costs involved with us doing that. We can drop that down for, you know, people on this call to probably more like 250, especially because we have some 1031 exchange investors in this deal already. And, you know, the costs of doing that get sort of spread across everyone that way. But yeah, we typically, because of the complexities involved, we wouldn't do a 1031 for like a $50,000 investment or something like that. Just wanted to give that bad news.
We can also do IRA investments, right? But they're gonna they're still gonna have to deal with the UBTI because this is gonna be debt finance, right?
Yeah, that would be the case. But we probably have maybe 10 to 15 self-directed IRA investors on every deal. And at this point, I think on first name basis with, you know, every IRA custodian operator in the country, or the people who process these deals. So we're getting very good at processing those very quickly. So yeah, you want to invest with a self-directed IRA, we can absolutely accommodate that.
All right, and then Marissa wanted to know, in today's competitive multifamily market, how can rents be 25% under? Is it possible that you could be overestimating your rental increase and repairs? I'll give my answer and then you tell me if I'm right. I think it's because this was an out of country investor, so they really were not in step with the local economy. But you take
that's absolutely right. And what I want to do is actually hold that question because I have a slide coming up in a little bit that actually has comps of I think it's like 10 different apartment buildings in the immediate area showing their rental rates and whatnot. So, you know, we definitely do our, you know, due diligence on these things. You know, we've done, you know, about 20 deals over the last 10 years. We've learned how to estimate these things fairly accurately. So with that, I'll keep jumping through here. And I was just still talking about the asset before we took those questions. And I was going to say that the current owners spent about 1.3 million in maintenance and repairs over the last 4 years. And we plan on spending 1.7 more to finish off their business plan, renovate the units, upgrade the amenities, and focus on bringing those rents up. And, you know, we've been all over this asset a million times, like literally crawling over it, having our contractors crawl over it. So we've got a really good understanding of the state of the asset and that our CapEx budget is suitable for it. I even know for a fact that we thought the roof was in worse shape than it was, and it's come back that we can do repairs that cost far, far less. So our CapEx budget is actually looking a bit stronger than what we have stated in this deck here. And the final thing I'll say is this is considered a Class B asset, but it's very much in a prime Class A location. So it's close to top restaurants and major retailers like Sprouts. It sits adjacent to the cross streets of McClintock and Southern Ave, which has daily drive-by traffic of about 30,000 cars, which is just such a boon for putting up big signs and getting people interested in the properties and, you know, being able to rent them really easily. So we're excited about that. And the average household income within a mile is over $100,000 US, and the average home price is about 450 to 500K. It's a really nice neighborhood with great homes and residents who take pride in their community. And lastly, the asset is a short drive, about 10 minutes to ASU, one of the largest universities in the country with about 70,000 students, really close to downtown Tempe, really close to downtown Phoenix. And, you know, both of those locations have a bunch of Fortune 500 and tech companies there, a lot of jobs, a lot of opportunity. Now with that, I'm going to jump into the market a little bit here. And we are talking about Phoenix, Arizona, the 5th biggest city in the country after New York, LA, Chicago, and Houston. It's a beautiful city. It's a sunny city with about 300 days of sunshine every year. The residents enjoy golf, hiking, and to cool off, there's boating, swimming, kayaking, and the many nearby lakes. There's world-class spas and resorts, an amazing food scene, an amazing art scene. Phoenix really is a bustling modern metropolis. And in addition to these things that make Phoenix a super desirable place to, to play, so to speak, the cost of living is much lower than comparable cities. It smashes the other top 5 cities for affordability. If you consider neighboring California, home prices and rents are half of what you'd pay in LA or San Diego, and most everything else is cheaper too. So for all these reasons, it's a super desirable place to live, and that's reflected in the data and stats that I'm about to share here. So I will start with population growth. Population growth is one of the fundamental things that drives any market. And Phoenix in 2021 ranked #1 as the fastest growing city in the US for the 5th consecutive year. In fact, over the census period 2010 to 2019, no major city grew faster than Phoenix. And that upward trend is actually intact. For sizable cities with over 2 million people, Phoenix is projected to be in the top 5 fastest growing cities between now and 2060, increasing in population by 67% from 5 million to 8.4 million. And I get it, that's a really long horizon to consider, but the point I'm making is that this is a long-term growth trend. In the more present, over the next 7 years to 2030, the 2 counties in Arizona projecting the greatest growth with 820,000 new residents are both in the greater Phoenix area, Maricopa and Pinal, and the Lenox is located in Maricopa. And another big factor driving the real estate market is the local economy. Phoenix has a huge GDP of 260 billion. That's more than double the growth rate of the US average, and it's almost quadruple other big cities like New York and LA, and cities like Chicago going backwards. The unemployment rate for the Phoenix MSA sits near 30-year lows. And as you can see from the slides in the prospectus, there are some huge companies that have corporate offices, not only in Phoenix, but right in Tempe. Amazon, Microsoft, big banks like Wells Fargo, big insurance like State Farm, American Airlines, Coca-Cola, and more. And on that note, the last thing I'll touch on is job growth. Phoenix ranked #2 for the best performing US labor markets in 2021, and its annualized growth rate through 2031 is projected to be more than 3 times the US rate. So all this growth and prosperity feeds directly into the real estate market and the future of this investment opportunity we're discussing with you today. We as multifamily investors benefit most when rents go up. And as we've mentioned before, actually I say that, but we might have skipped over that because we're shortening this down. But basically when rents go up, it increases the net operating income of the partnership, of the asset, of the business, which results in a higher value come sale time. So, and more cash flow throughout the hold. So that's really key here. The more we can push those rents up, the more valuable the asset becomes. And rent growth in Phoenix before COVID, Phoenix rent growth was above average compared to the nation. As COVID eased, rent boomed nationally, as most of you guys probably know, and in Phoenix even more so. Depending on your data source, rents boomed 25 to 40% in 2021, which is obviously huge. Now, nothing can go parabolic forever, and rental rates have evened out in 2022, and we see the market stabilizing as we enter the spring leasing season and continuing to grow more conservatively over the next few years. And that's fine, because in our business plan, in our underwriting, in all of the numbers that you're seeing, we're not relying on market growth. And forgive me, I'm reading my notes here just to make sure I'm covering the key points. I'm just going to actually sum up here and just say that, Phoenix is, it's a great market, super desirable place to live. Population is booming, economy is booming, jobs are booming, and all of these underlying trends that make it such a great market are still intact and still moving upwards. So industry experts and the team here at RSN are anticipating continued long-term growth in the Phoenix real estate market. So with that, I'm going to transition to these assets, but I will pause for questions.
Yeah, I have a question. Where are you in the purchase process? Have you guys signed the contracts? Has deposit gone hard? How did you find the property? And what markets are your other properties in?
Yeah, so we've got a couple of properties in in Mesa, and we've got one in another location, Phoenix, that apologies escapes me right now. And then we've got this one in Tempe. We also have another asset in Greenville that has been purchased under the RSN banner. And we have a bunch of other assets that have been purchased with Reed as a principal on them, but no longer as an active manager. Just to briefly touch on that, he wanted to diversify geographically, and his business partner wanted to stay in Texas, where they had a big background. So that's sort of how we ended up, looking in these other markets. Your other question was about where we are in the purchase process. So we signed the contract, gosh, I don't know how long ago, a couple of months ago, maybe. We've sent a bunch of non-refundable deposits that are locked in. We've got the financing almost locked down. You know, those 1031 exchange investors actually have to sign on the loan. So that's an additional complication there that we're working through right now. And what was your other question, Ebere?
How did you find the property? And then I think you already talked about other markets, but when was the contract signed? And then how did you find the property?
Yeah, so we got awarded the contract on like January 1st. And I don't know exactly when we signed the contract, but it would have been, you know, within the 1 week after that, you know, agreement was made, or maybe 2 weeks. So, you know, I guess that's 6 weeks ago, approximately. And we found this property just on the open market. You know, we've got great relationships with all of the brokers in Phoenix because we've been there for a while, and they know we buy assets. They know we are good to do business with, all that good stuff. And this was a 6-pack, and with a group called IPA. The broker is called IPA, and we bid on 3 of the assets, and we were ultimately awarded 1 of the assets. And the other assets went to, you know, operators that, in our opinion, were significantly overpaying for these assets, like, you know, 20-30% more than our underwriting thought prudent. So that's how we ended up with this one asset.
Hey, can you take us back to the cap rate and then the cap rate trend or projection?
Yeah, what slide was that on?
I think, wasn't that, yeah, you keep going back. Yeah, is that it?
So, yeah, I'm not sure where that was, but rather than poke around for it, maybe it was, yeah, rather than poke around for it, I mean, I can say we're going in with a 5.4% cap rate, which is less than our loan interest rate. So, you know, for that and many other reasons, we're going to be cash flow positive from day one. And we're actually expecting the cap rate to expand upon exit, which means we're in our underwriting projecting that the market will deteriorate from where it is. And that's not common for people to do. Almost every underwriter, you know, paints a very rosy picture and imagines that the market is going to do better. Now, we actually think the market is going to do better, but for the purposes of underwriting and coming up with numbers, you know, we skew on the conservative. So I think the exiting cap rate is 5.8, if I remember correctly.
And how many rounds did you guys have to go through before you got to the sale? How many rounds of bidding?
Oh gosh, that would be a better question for Reed. You know, but the usual process is, you know, you give initial offers, and, you know, then the broker, you know, calls you and butters you up and gets you to push it up a couple of times if you can. And then they do a best and final round where everyone has to, you know, come up a little bit more, and you know, then they ultimately, you know, decide on a winner. So I don't know the ins and outs, but I would guess that we had 2 or 3 rounds on this one. Okay, well, with that, I'll keep moving through here, try to get back to where we were. So we'll talk about these assets a little bit more in the business plan. And, you know, we've already talked about it being a Class B asset in a prime Class A location, great schools, great community, easy access to 4 major freeways, short commute to downtown Tempe and downtown Phoenix. And, you know, that's that. Now we're going to actually get into the business plan now. So the asset specific business plan, again, is to finish out the necessary interior and exterior improvements, upgrades to the overall property and amenities, new paint, landscaping, dog park, all that stuff I've covered. And we're going to put in a bunch of landscaping to reduce the need for water usage, which is really important in Phoenix, not only from doing the right thing by the environment point of view, but from a cost point of view. So you can see here, we're going to put low flow toilets and, you know, water saving shower heads and whatnot in the properties. And we literally save hundreds of thousands of dollars on these deals just by being a little bit more conservative with water. So that's a big thing for us. Of course, we're going to renovate the units like we talked about. We're going to look at some of these comps that I told you I'd show you for the rental prices. And we're also going to add reserve parking, install washer, dryer, hookups and appliances in all of the 3 bedrooms. And we talked, I spoke briefly about our conservatism in underwriting. And again, we constantly use worse numbers than we think will actually happen. it's way better to under promise and over deliver than the other way around. And let me jump straight to these sales. So these are the sales comps. So if you look here, we're getting this for a 25% discount compared to other properties that have sold recently. Now, part of that is just because interest rates have risen and the value of the properties inherently drops because of that. But we still are getting this property for a really, really great deal here. And this is the sale comps. And then we'll jump over here to the rental comps. And you'll be able to see here that, like I said, we've looked at, whatever it is here, about 8 properties, and then some of the 3 beds here. And yeah, the current owner has really just been asleep at the wheel. There's a huge amount of opportunity to push the rents up on these units, even before we renovate them. By the time we renovate them, we think we're going to do even better.
So you're counting on the cap rate plus the increased ROI, which ultimately increases the value in terms of the exit strategy. And then do you have a certain length of time for your exit? Are you guys, or is it kind of open-ended?
Yeah, we underwrite these deals to a 5-year hold, and we will look to sell earlier than that if we can meet the projected returns that we've talked about and the market conditions warrant it. In this case, I know, for example, our loan has certain penalties that don't make it practical to exit before 4 years. So we'll almost certainly be holding this property for at least 4 years. But I imagine would be in that 4 to 5 years, a point that we'll be actively looking to make an exit out of this property. So that's what we're going to do there. And I'll touch on the CapEx budget here. So this is what we're planning to spend. We've got contingency in there. This is one of our fees, actually, I'll call out. This is a construction management fee of 5%. So our property managers don't handle any of the renovations. We have a general contractor who reports directly into us, and the property managers are only focused on leasing and dealing with tenant issues, and we find we get much better results that way. And our fee is 5% of the CapEx dollars that we actually spend. So over the full life of the hold, if we spend that 1.7, we'll get paid 5%. If we end up spending less, we won't get paid that. And that's basically how the CapEx budget works. And I will also add that we don't negotiate with our general contractors or any of our contractors over parts and materials. We only negotiate over labor. We get all of our materials shipped in from China, and they go to our warehouse in Dallas and then get distributed amongst the US to our properties. So, we control our supply chain a hell of a lot more tightly. We have a lot of opportunity to get product when other people might struggle, and we're getting it at a great price. And, we've been working with our team on that process for a number of years now. So we don't have any problems with quality or issues like that. So we've got that humming like a fine-tuned machine. And the last thing I'll say is, the economies of scale with our renovations operations, because we already have 3 investments in the area. There's a lot of synergies there. So, we don't need to, if hypothetically this property was in Dallas, we'd need to ship materials there again, which would cost extra because we already have assets in Phoenix. The cost is, shared across all of those assets. Now we'll talk about the debt. And what I will say here, just before I start, is this interest rate says 4.9%. And we don't update this deck as the deal changes from the start, because quite frankly, little things change every day. And this interest rate is not 4.9% now because interest rates have picked up. It's going to be in the low 5s. But otherwise, everything else is pretty much the same here. So, we're raising all of the CapEx dollars from equity. It's going to be 62% LTPP. It's interest only for the full 5 years. And yeah, that is the debt terms that we managed to secure for this one. Just give me my notes here for other things that may be relevant here. Yeah, another little interesting thing is that we actually have the ability, if we wanted to add additional density to this property. So we're allowed to build it up to 45-foot height, just 3 to 4 stories, and there's currently only 2 stories. We're not going to do that, but it's very much the kind of thing that we can target a developer and let them know, hey, there's like a big opportunity here if this is something that you do on a regular basis. So in addition to selling to, the kind of people who want to buy well-running asset that they don't need to do any work on, we can look to developers as well. So finally, I want to talk about the equity structure and the investment returns for this deal. So we've got three classes here. The first class is Class A, and this is your pure cash flow class. It's for investors who want high consistent cash flow. It's a 9% cash on cash return over the full life of the deal, starting with day one and ending the day we sell. And Class A sits in front of Class B and C in the capital stack, which means that, heaven forbid, the deal has issues. Class A gets paid first, and then Class B and C get paid next. And that's why the returns are going to be less for Class A. And if you're looking at these preferred returns, it's 9% for Class A, 9% for Class A, 7% for Class B, 8% for Class C. But the key difference here is there's no profit split upon sale for A. So they don't get to enjoy any of the upside on the deal when we sell. So it's a much safer investment, slightly lower returns, but it's really good for people who can't afford to lose their capital, or people who want to replace their income, people who are close to retirement, or people who just want to have a safe investment that they don't have to think about, for whatever reason. And then we've got Class B, which is your classic, investment class that all syndications have. So you get a 7% preferred return, and on sale, you get a 70-30% profit split, with 70% of the profits going to the investors, 30% going to us as the operators. And Class C is if you're investing $500,000 or more, you get slightly better returns, an 80-20 split on the back end, and an 8% preferred return. And we'll look at some of the returns here. So this is the Class A. You'll see you get your $9,000 every year, and then upon sale, you get your $100,000 back, and you end up here with your $145,000 over the 5-year hold. And Class B, again, you get higher returns because you're getting that profit split on the back end. But there's some key differences. For example, the preferred return, we're not hitting that preferred return in the first couple of years. So you only get 2.5% year one, 6.7% year two, and then it picks up on year 3 and year 4. And if there's any pref that we haven't paid out upon sale time, you get paid that out first before we then start, returning people's capital. So you will get that 7% return based on the projections of the deal. And Class C, again, same thing, but it's, if you invest 500,000, you get that preferential 80-20 split and the 8% preferred return. So that's basically it, in summary, we love this deal because of the incredibly strong long-term fundamentals driving the Phoenix market, and because we've got a 5-year hold, so we get to, benefit from those. We're buying the asset at a discount to what other assets have been selling for in the past 12 months. We think we're getting a great price. The rents are well below market, so we can get that upside before we even begin the renovations. We've remained very conservative in our underwriting, so we're confident that we'll hit our rental rates and occupancy and all of the targets throughout this deck. The debt terms and the cap rate are really, really good. And in terms of debt, I don't know if I mentioned this, but the loan is fixed, so we don't have to worry about the interest rate changing throughout the deal. So that's great. And of course, we've got the 3 investment classes we've talked about, so you can pick the one that works for you. And I could go on, but for these reasons and more, we're looking very forward to welcoming this asset to our portfolio here in the coming months. And again, if you wanted to invest, you would go to rsnpropertygroup.com/commit. And here's the timeline here. So the way this works, you'll see these dates. We've already hit some of these dates. This has been updated. So the funds wired date was it's today, actually, March 3rd. But we always have people straggle, when we're dealing with these high-powered accredited investors who earn a boatload of money. Everyone thinks the rules don't apply to them. So we normally end up taking investments after we set these dates. Don't publish this publicly, Ebere. I don't want to encourage that behavior, but that's just what we see. The short story for you guys is that we are going to be closing in the end of March, mid-March, and you still have opportunity to get into this deal, should you want to get into this deal. And with that, I will jump to the live Q&A.
All right, I have a couple of more questions. So exactly how much are you looking to raise additionally? And what if you were able to raise enough to do cash?
To do a straight cash purchase?
Mhm.
Yeah, that I mean, that's not on the table for this deal, just because of the timing and everything that's going on. But you know, for future deals, it's something that we could consider. But you know, as you know, and a lot of the other people on this call know, the use of debt can enhance your returns. So it often is smart from a financial and return point of view to use debt. So we're always looking to do that. Obviously, it reduces risk in some ways, changes risk in other ways. But you know, we're almost always going to use debt on these deals. I think we'll always use debt on these deals is the short answer to that. And your first question was how much do we need to raise? The total that we're raising for this is 10.8 million. And the purchase price is 20.3 million. And we are currently at about, gosh, like 8.5 approximately. So we've still got some room up our sleeve. And one thing that I will say, we actually had this deal get taken on by Realty Mogul. So if anyone's familiar with Realty Mogul, they're one of the biggest crowdfunding and investment platforms out there and in America. And we've been working with them for a long time to kind of get our foot in the door, and they're taking this deal on, and that should go live in the next couple of days. So we're expecting them to fill that shortfall pretty quickly, along with the rest of the team that's already working on this. So again, there is opportunity for people to invest in this deal should they want to, but the window is definitely closing.
All right, and then there was a question about whether or not an Arizona tax return will need to be filed. The answer would be yes. But we would expect that the first couple of years that you're not going to have, you would have a tax filing requirement, but you're not going to have any taxes to pay because with depreciation and all that, it's probably going to be in the negative. And then upon exit, then you're going to have a non-resident return to file in Arizona based off of the capital gains. If yours is a straight return, then yes, you're going to be looking at that 9% that you're going to be getting every year as a return on your investment. That's going to be filed every year on a non-resident return in Arizona.
Yep, that's right. And you touched on something important there I might not have mentioned. That full 9%, you know, will stay in your pocket because of the tax benefits inherent with this deal. So you're not going to get taxed and end up with, you know, $5,000. You will have that $9,000 in your pocket, just due to the losses that the partnership generates.
How much is RSN investing?
We are investing as a co-GP team. Last count was 500K, but I think it's actually picked up a little bit from there. Now, we normally invest a little bit more, but this is actually the first deal that we're doing where we are not having co-signers on the loan to help. You know, basically with these loans like this, the bank will often, you know, require people with high net worth to sign on the loan. So if something goes wrong, you know, they can get their money. We're doing it ourselves, which is a big step for the company. And because of that, we need to maintain pretty strict liquidity requirements. So we're not able to invest as much as we usually do or would like to do. But yeah, that's the answer, around 500K, Ebere.
Okay, and then is there a reason why you guys decided on a 50% equity investment?
Just the way we underwrote the deal. So, you know, I know the guys, you know, look at these deals every way to Sunday. So I'm sure that we looked at, you know, different ratios and how that impacts the returns. You know, I know with interest rates rising, the more equity that we raise, the less debt, you know, we have to pay on a monthly basis. So that's a big factor. And as well, if we raise the CapEx dollars from equity rather than getting a loan from the bank, when you get a loan from the bank, you know, it's like a hard money loan, but on a bigger scale. You know, they have to review the contractor's contract. They have to question it, review it. It takes, you know, God, it can take 2, 3, 4 weeks. It's just a huge paperwork nightmare. So we made the decision to raise all of the CapEx dollars from equity so that we can just deploy them as we need, as quickly as we need to.
All right, any other questions? You can stop sharing your screen now.
Sure.
Ben. Any other questions? All right, so one of the questions that I want to bring to you guys' attention is why am I allowing Ben to present to our clients? one of the things I've noticed is that there's a lot of people out there who are doing real estate, but because I usually have to prepare tax returns, have to set up entities, have to do tax planning, I'm watching out for clients who are really trending up and doing very well and staying true to their core values. And what I see on paper is actually what they're actually doing. So if you see somebody who comes on and presents to you and you're presenting to my clients and I'm bringing them out, is because this person has done very well and I'm able to verify them without them even knowing that I'm verifying them, because I watch patterns. We do a pattern analysis every year to see how are people doing. And so Ben is one of those clients who started with me even before he really got into investing and has been trending up significantly. And so when things like that happen, then you pause and ask yourself, hey, what is it about what this person is doing that's causing them to trend up like this in real estate? And one of the big differences that I've noticed with Ben is, one, he's partnering with the right people. He moved more into the commercial space. He is now in a position where he's kind of the one that's brokering the deal, finding the partners and dealing with other people. Like, as you can see, I asked a lot of questions about the team because I always want to go back through the scenes and see from where this person started to where they are now, what are some of the changes that I've noticed. So all of this is to say that if you do make a decision that you want to invest with Ben, you know, this is somebody that I'm able to vouch for. I would not even bring him on to make this presentation if I didn't think that you would get a good return on that investment. So if you make a decision that you want to move forward, reach out to me, reach out to Ben, and then we'll be able to take it from there. If there's no other questions, I just wanted to talk to you guys about something very small before we round up. Any other questions? I'm looking at the chat to see if I have any other questions before we move on. Okay, somebody asked about your management fee. And then somebody asked if I'm able to file the Arizona tax return. Yes, we file in all 50 states. So we actually are filing some Arizona returns now. Now, the whole thing about the UBTI IRA, you do need to take that into consideration. But a lot of times, even with because of the return on investment that you're getting on the investment, the UBTI taxes, that just gets factored in and analyzing how much it is that you have to pay out and what your net return on investment is overall.
Yep. And I think, I'm sorry, was there a question in there for me as well, Ebere?
Yeah, the monthly management fee.
Yeah, of course. Okay. So there's 3 key fees that we charge in all of these deals. One of them is a 2% acquisition fee, and that's paid upon closing on the property. And that goes to us as operators, and that effectively, keeps the lights on and covers our costs for, securing the deal. And then upon sale, we obviously get our split at the end that I talked about. And then there's 2 other fees, which is the asset management fee, which is 2% of the revenue that the property generates. And then there is the construction management fee, which is 5% of the CapEx budget that we spend. And I will point out that they are very low fees by industry standards. We pride ourselves on being a boutique shop with a small team. We don't do a bunch of different kinds of deals. We're hyper-focused on value-add multifamily in a few key markets. So we're just rinse and repeating the same business strategy again and again and again. It's really boring, but it works and it makes money and it allows us to do it really, economically.
And Ben, please put your contact information there. You are free to contact Ben directly, but please be very, very respectful of his time. I only want those who know they absolutely want to invest contacting him. This is usually a very private meeting where we're offering this to clients, but we don't want to abuse our clients and the confidential privileges that we have of being privy to some of these deals that you typically may not see out there. And then when you contact him, let him know that you came from the Wealth Building CPA. All right, so go ahead.
Absolutely. And 2 last things. This deal, I don't know if I mentioned this, I think I mentioned on the last call, but because it's a 506c SEC registered offering, we are only allowed to accept accredited investors. And this means investors who, as an individual, have earned $200,000 of gross income in each of the last 2 tax years, or $300,000 with their spouse, or a net worth of over $1 million. But I will say, if you think you're on the cusp of that, do talk to me, because there's a bunch of stuff that people don't think about that can go towards that money. So 401ks, annuities, there's all sorts of little things that may be applicable to that. So, I'm happy to chat that through with you. And lastly, thanks so much, Ebere, for, letting me present this deal to the group. Hopefully a couple of people join us on this one, get great returns, and, we can, maybe get you guys involved in the next one.
Thank you. All right, so let me just share this real quick before we go. One of the things that we're looking at is in terms of how we spend our money and building wealth and getting into real estate, is we do want to think about our core values, making sure that you're living in alignment and that your real behavior aligns with your core values. So it might look simple, but it can also be very difficult. And one of the things that we're realizing is that people that we have seen that are successful in building wealth and staying the course in real estate are people who align their values with what they're actually doing. So it's important that you think about the ideal you versus the real you, and then your values may change over time, but it will be good to get into that exercise where you're aligning your core values with the behaviors. We are partnered with the Legacy Builder Group, and we are going to be doing this when we do our business meetings in May, June, but I wanted you guys to bring this to you guys ahead of time. If any of you is interested in getting started, we will go ahead and send you the exercise worksheet so you can start looking at it. But we want you to look at the values that fit you well, the 15 values, then you narrow it down to 10 and narrow it down to 5. Our goal is that we want to know what those values are, so that when we see deals or as we're preparing your return, as we're talking about building wealth, we know the things that drive you, because those things that drive you end up impacting what you think about money, how you spend money, how you invest, how you relate to others. Okay. So I'm just going to go through it real quick and then we'll be done. We look at, where do you place value on achievement or adventure or autonomy or challenges, change, community, competence, competition, cooperation, creativity, decisiveness, diversity, ecology, education, ethics, excellence, excitement, fairness, fame, family, flexibility, freedom, friendship, happiness, health, helping others, honesty, independence, integrity, leadership, loyalty, meaningful work, money, order, philanthropy, play, pleasure, power, privacy, recognition, relationships, religion, safety, security, service, spirituality, stability, status, wealth, and work. And you can add on other things there. The reason why we are going to start requiring our Wealth Building Plan members to go through this core value analysis is because we want to increase the rate at which you're building your wealth. We have seen a lot of success with our clients, but we want to increase that success rate. And we're realizing more and more that to increase the rate at which our clients are achieving their goals, which is being able to establish financial freedom that now enables you to do whatever it is that you feel that you've been called to do to fulfill your destiny. We want to start aligning your core values with all the things that we're helping you achieve financially. So that's just a short snippet. Of course, we're in the thick of tax season. For those of you that haven't sent in your paperwork, we are going to be sending this out. If you have any questions, please feel free to reach out. So we will just take additional questions until it is 1 p.m. Raj is asking if I am going to be associated with this investment deal in some way. I am talking to Ben and kind of watching and seeing how things are going and kind of seeing the appetite that our clients have for the deal. Usually what would happen is that I end up will invest in a deal if I have a couple of clients who come in and say, hey, we want to invest and we're going to be moving forward, and then I'll go ahead and invest. I have so many other deals that we are participating in or that come to us every day that we're very picky about which deals that we invest in personally. So if I get at least 3 or 4 clients on here who are going to be investing, then I'll be talking to Ben and saying, hey, we want to be a part of this and we want to join in and also invest as well. Okay, any other questions as we wrap up? Any questions about the core value? I'm so glad you guys came on. Hi, Victor, nice to see you. Hi, Gail. Hi, Ayo. Hi, Ravel. Hi, Wes. Hi, Dina. Hi, Lorelai. Hi, Wanda. Hi, Martina. Hi, Joshua. Hi, Randolph. Hi, Patrick. Hi, Terry. Hi, Cola. Hi, James. Hi, Eric. Hi, Asim. Just saying hi to all of you. It's nice to see all of you in here. Do we have any additional questions, or Ben, do you have any more comments as we wrap up? Hi, Pierre.
No, nothing for me. I do have a hard stop at 1 o'clock, so if someone has a question, I can quickly answer it, but then I am going to have to jump. It's a call I'm sharing with about 12 people on there.
Well, Ben, Ebere, thank you so much for putting this together. Ben, thank you so much for your time. We truly appreciate it. That's all I have to say.
Cool. Thanks, Patrick. Nice to hear from you.